Let's start with like, share and subscribe. Hey everyone, today we're gonna talk about EBITA, which stands for earnings before interest, taxes, and amortization. Basically, it's a financial metric that helps investors and analysts figure out how well a company is doing by measuring its earnings without taking into account interest expenses, taxes, and amortization. So, why is this important? Well, EBITA gives us a clearer picture of how well a company is performing in its core operations, without all the extra stuff like taxes and interest that can cloud our judgment. This makes it easier to compare different companies in the same industry and see who's doing better. However, EBITA has its limitations. It doesn't take into account changes in working capital or capital expenditures, and different companies might calculate it differently. So, it's important to use EBITA alongside other metrics and take other factors like competition and industry regulations into account when evaluating a company's financial health. That is correct. EBITA and EBITDA are both commonly used financial metrics to measure a company's profitability. EBITA, earnings before interest, taxes, and amortization, is a measure of a company's operating profitability before the effects of financing, accounting, and tax decisions. It is calculated by subtracting operating expenses, excluding interest, taxes, and amortization, from operating revenue. EBITDA, earnings before interest, taxes, depreciation, and amortization, is similar to EBITA but also includes depreciation in addition to operating expenses. Depreciation is a non-cash expense that represents the gradual decrease in value of a company's assets over time. In short, EBITA is a useful tool for investors and analysts to measure a company's financial health, but it should be used in combination with other metrics and taken with a grain of salt. Thanks for tuning in, and if you have any questions, feel free to reach out.